And here we are. Thank you, Ira, for reminding me that I should hit record. But just to replay what I just said, I'll throw the navigator up for each section so you can tell where we've been and where we're going. So to begin, let's answer the question, what is accounting? When it is whittled down to its very core, the purpose of accounting is to identify, record, and communicate. I saw that in your notes. Here's where you'd want to highlight that and emphasize that I, R, and C, identify, record, and communicate, are very, very important. What are we identifying, recording, and communicating? The economic events of the organization to the interested users. Those could be internally, those could be externally, and we're going to give some examples of those in a minute. The key here is economic events. Some things are not identified, recorded, and communicated. I'll give you an example. If we interview a possible new employee at HR, that's not recorded. It happens, but it's the job of the accountants to go, oh, we're interviewing new employees today, possible new employees today. They're not going to run back to the books or their computer system and record anything. That's happening. It is an economic event, but it's not one that after we've identified what's going on, it's not recorded. Whereas when we actually hire and pay the new employee, that's different. That is an economic event that has impact in the accounting books. So interviewing them, even hiring them, I shouldn't have put maybe the word hire there. The hiring of a new employee, not so much. But when we start paying them or withholding money out of their account, then all of a sudden that's economic. So the key here is what really do we record? And I think that new hire example is a good one. We're going to take a look at these three a little bit more in depth. This would have been on your supplemental handout. So here's when you'd want to go to that handout and write anything I do. Okay. I use local businesses a lot as examples as well. I might say it right. I might say it a little bit inaccurately to what they do, but I'll use Willys as an example. Okay. A lot of you work at Willys, and a lot of you shop at Willys, or at least have been through the store. And if you think about all the money handling that goes on there in a given day, the person in charge of the books there has their work cut out for them. Again, what is accounting? Well, we're identifying what economic events even have dollar amounts attached to them. Okay, are there things that happen at Willys that wouldn't be recorded in the books? Certainly. Okay, but someone has to identify, well, where's the dollar amount here? Where are dollar amount related activities happening? Then someone goes to record, classify, and summarize them in the recording process. This really is the bookkeeping side of things. I might have spelled that wrong, so my apologies. Are there 2Ks? Are they, after every time they sell to a customer in the checkout line, running money around the store? No, they're not. At the end of the day, I bet all the cashiers at the day end have to count the money and record something and then run it to someone else. And even at that point, are they making deposits every day? Yeah, probably. So we've determined what activity or what economic event. Now, I'm not talking like big astronomical economic events like what happened worldwide. Economic events that are happening inside the store of Willys when money is impacted. Then we record the money. But then, more to the story, we communicate it. We tell this money story. We're preparing communication devices, so year-end reports, maybe weekend reports. Everyone does it a little bit differently. We're communicating to both our internal and external people. A lot of you work at Willys. Do you know the financial standing of Willys? Probably not, but they probably tell you about when there's big days at the store, or how to prepare for big days at the store. Okay. The federal government's going to want to know how things are going. The state of Minnesota is going to want to know how things are going in the store. Okay, so we decide what we're even going to identify as an economic event that has financial impact. We record it, and then we tell that money story. I, R, and C. But the R part's kind of like a duck on water. They look really cool and calm on the surface, but they're working their tail off, or in a duck's case, they're paddling under the water to keep all of that money story happening. These two illustrations are also in that supplemental handout. Managerial accounting is known as, the internal users are known as managerial accounting. I believe in that article that we read about, it was called management accounting. How is our money internally managed? Are the accountants the only people that care about how the money's going, flowing in and out? Probably not. Everybody in the organization has a hand in the cookie jar. It's just the accountant's job to tell that story. Why would the marketing department be concerned with how much money we have? Well, can they run that big Super Bowl ad? Is there enough money to do so? For a company like Apple, yeah, they probably have enough money to run the Super Bowl ad, but is it cost effective? Is it going to bring us more revenue? Okay. Should we go with a free social media this or that, or should we go much more elaborate and get our in the print media world? So they have to know what kind of budget and how much money they even have to work with. But the bigger picture is it going to then turn around more revenue and results? Okay. Management, I think that's obvious why they're going to be concerned with it. The people at the top making the decisions work closely with the finance department to make sure we can stay afloat. Why is human resources concerned with how much money we have? Yes. Got to be able to pay people. Should we hire more, or do we have to lay some off? So inside that money story that is under the C, what C stand for in the I, R, and C? Communicate. That's huge. Financial accounting are the outside people. I'm an outside person to Willys. I shop there. But do I need to know their financial report on a given day? No, I don't. But I care to see that they're doing good for the community, that they're employing a lot of people in our community, and that there's groceries available. You really can look at it, I think customers should be on this list, but the book chooses not to, but maybe you should add customers, okay? But who are the investors and who are the creditors? Who do we owe money to? If we owe money to someone, do you think that they are pretty concerned with how we're doing financially? Yeah. They're looking at our balance sheets and income statements. They're looking at our financial reports. We're talking to them because we owe money to them. Investors, so people or businesses who put money into our business and maybe get money out of our business, they also are going to be pretty concerned with how are you doing financially? And that is really a big piece of the I, R, and C. Here's where the C is really important. How well are we telling our money story for the people we owe money to or the people that invest in us? Big corporations will have annual meetings and maybe even semi-annual meetings to tell them the money story. If you invest money, even $5-10 into a business, especially if it's a corporation where it's owned by the shareholders, you better have some pretty rock solid financial reports to share with the people that own a portion of your business. Managerial accounting is inside. Financial accounting is outside. That's all of Section 1. Let's move on to Section 2. There's lots of principles in this section, right? So let's, before we get into the principles, let's talk about the ethics involved here. Have businesses locally or on a worldwide scale gotten into trouble for cloudy or muddy money? It happens all of the time. The larger the business, the more the media wants to exploit them. It's against the law. So much that Congress, Uncle Sam, said back in 2002, we want to put into legislation a law that forces businesses to ethically approach the reporting of their money. It's called the Sarbanes-Oxley Act. I might be botching that. I want you to just remember SOX. SOX Act. Sarbanes-Oxley. Again, I could research that a little bit more. I would assume the book told you that a little bit more. I just remember it's the SOX Act. That, in a nutshell, is trying to avoid unethical financial reporting. I'll read to you what it says. United States regulators and lawmakers were very concerned that the economy, so our U.S. economy, would suffer if investors lost confidence in corporate accounting because of unethical financial reporting. Investors, again, we talked about investors. That's who people that put money in and hopefully get money out of a business. It can provide a very economic, unsettled, unrest feeling if some of the top dogs are unethically reporting. They're withholding revenue here or making it look like our expenses are higher other places. There have been some public scandals, you know, Enron. Maybe you guys are too young to remember Enron, but Enron, WorldCom, HealthSouth, and AIG were some big ones that did some very legal things, but, you know, did the media skew things? You could argue that, but still, whether they did or didn't, people, investors, or just the economy becomes shaken a little bit by some of those bigwigs doing that. So the federal government said, we're going to pass a law. We're going to remember that law is called SOX, S-O-X, to just prove to have more effective financial reporting, just with the ethics that are involved with it. So what do you need to know about SOX? It's the government's way of making a law that stops unethical behavior and rather depends on sound ethical behavior in what we see, or in the C part. You know, there's identify, report, and communicate. We want ethical reporting on the communication side of things. And really in all of them, they better be reporting the right numbers as well. What questions can I answer about that? I'm not going to get into huge amounts of government accounting and all the legalities with it. Just know that there are laws in place that promote ethical financial reporting. This section, just more about ethics, you see a lot of the same things. They want to, when you're recognizing and identifying, it's not just about the C part of it. It's not just about what the money story that's told. It's recognizing the economic events correctly, recording them. See there, it's an I and an R, so don't get confused again. It's just the IRC across the boards is ethical and honest and truthful. We read about GAAP last Friday in our article. GAAP stands for Generally Accepted Accounting Principles. My little recording icon is covering that, but what is a principle? And I'm not talking about Mr. Kehoe here, but what's a principle? It's just the idea of like a fundamental truth. I want you to write that down. Believed to be true. It's just kind of a, like your gut instinct will say that if you're following a certain principle, you're following a fundamental truth, just kind of believed to be true. We've got a lot of arrows here. What you need to remember about GAAP is that it's a generally accepted accounting principle, that fundamental truth. And it almost comes back to that word ethics. It's actually like a whole governing body, so to speak, in the accounting world. The accounting profession has attempted to develop a set of standards that are generally accepted and universally practiced. It's like when you walk into a doctor's office, there's an unwritten set of rules. They're not necessarily listed on the wall. Sometimes they are. Okay. Sometimes I see their medical degree in a picture frame when I walk in, and that almost gives me the sense of there's a fundamental truth here that I'm going to be given the best care possible. Well, a lot of times when you walk into an accountant's office, there's some big frame degree there as well. That there's that fundamental truth that they are going to approach their money story the same way. When you walk into a classroom, there's a fundamental truth that that teacher is going to follow a set of ethics. So it's kind of like the unwritten rule, the writing on the wall. Okay. They produce lots of financial statements in the C version of the IRC, so identify, record, and communicate. They tell the money story through all of these things. We're going to learn about them later in the chapter. You recorded a lot about them yesterday or over the weekend. But what it all boils down to is GAAP. When they're making their balance sheets and income statements and telling the money story, GAAP is kind of that big brother watching over them. Yes. Well, they are. They are. This is actually like a governing body. It's just kind of like, like the unwritten rules I mentioned, the writing on the wall, the framed degree. Right. It's just kind of like you better comply. And yeah, Ira's right. There's probably a whole long, if I went to, generally accepted accounting principles, like I said, there's probably this big governing board. Yes, there is probably a big handbook. There's probably lots and lots of written rules. But it's just kind of that I better expect that you are a CPA, you are a certain accountant, the business has an accountant in-house or hired one out. They're following that fundamental truth that pertains to their industry. The Pro Code of Accounting. Yes. Let's talk a little bit more. A set of rules and practices with very, very, very much authoritative support that the accounting profession recognizes just as their general guide. So I probably use the word unwritten rules a little bit loosely and in a cliche way. Yeah, there's probably a whole long list of them somewhere. What you need to know is there's all sorts of boards or governing bodies, if you will, both on the domestic and international level. I don't necessarily need you to remember word for word what they are, but rather they're acronyms. The Security and Exchange Commission, or the SEC, I'm not talking the college, isn't there an SEC in college sports maybe? Not that one. This is more the financial realm. Okay, these are the domestic governing bodies, if you will. And then we have the International Accounting Standards Board. That's on more of the worldwide or international scale. So the SEC and the Financial Accounting Standards Board, or FASB, more domestic, whereas the International Accounting Standards Board is more of the worldwide. There is the international note. If you look at what is on my slide, you know what? I haven't connected to your computers, have I? Can you guys see okay for today? All right. I'll make sure that they're connected, though, at some point. Over 100 countries use the International Financial Reporting Standards, or the IFRS. For example, all companies in the European Union follow the international standards. The difference between U.S. and international standards really aren't that big. It's just, again, that big brother kind of floating over us saying we better be following all of these principles and ethically reporting what we do. Here comes some more principles. Have the vocabulary in your notes, but please have some of my examples that I'm going to give you. You'll notice as we go through them, here's the historical cost principle, here's the fair value principle. They all kind of start to sound alike. Would you agree from your reading that they're all a little bit like we dumped them in one big jar? Just remember, the word principle is that fundamental truth. Kind of that gut instinct of, as we go into this profession, and every profession seems to have their fundamental truths that exist. The fundamental truths are listed for me as a teacher. There's things I should and shouldn't do. Same thing in accounting. What's the historical cost principle? Well, it dictates that companies record their assets at their cost. Assets are things that they own. Cost is what they paid for them. Again, you're going to hear lots of local examples, and I use my own Junk by Jenny business a lot. Okay, I'm a dumpster diver. I'm a slam on the brakes when I see something free in someone's yard. What is my cost at that point? Nothing. Okay, ooh, I'm glad Ira brought up fuel. That's going to be an example here in a minute. Did I pay for the chair that was on the curb? No. So when it comes time for me to communicate my money story to, say, Uncle Sam, just a second, Ira, I better not list that I paid $2 or $3 for that chair because it was free to me. Now, Ira brought up a good point. What about the gas me cruising around dumpster diving, or the gas involved with me, you know, curbside pickup? How about the gas that it took me to get to Ace to buy spray paint to do something to that chair? Well, that's different. That wasn't the cost. Those were expenses, and we're going to get into the differences in a minute. But it's just, if I buy land for $90,000, that example is what we're going to see in the end of chapter work that we do. If I buy land for $90,000 and then all of a sudden it increases to a value of $93,000, the historical cost principle, or the cost principle, says I better report that land at $90,000, not $93,000. Your question, Ira. I did. Yes, there's time. You got to pay yourself or pay your employees as well. But that's a huge expense instead of the cost. The fair value principle, again, another fundamental truth, states that assets of what we own or liabilities of what we owe, that's going to be tomorrow's lesson, should be reported at fair value. Again, you can't just pull numbers out of thin air. What's the going rate? What did you pay for it? So both of these principles basically take a look at, you can't put a value on it, it's what you paid for. Let's take a look at a few more. Now we're getting into some assumptions. These aren't necessarily principles, these are assumptions or things that you should just assume. Ira, before I get into this, did you have a question? Sure. Yes. So the difference here is you Yeah, Ira's right. You better, depending on which principle you're using, it impacts which, like, did I pay? I'll use the 90,000 because that's what you're going to see in the end of the chapter. If I bought land for 90,000 under the historical cost principle, you better keep it at 90,000. Where down here they'll say we'll let you increase it based on its current value, its fair value. But then arguably, who gets to make that call? Who gets to say your land has increased to 93? So I'd say the cleaner way to go is the historical cost. This is what I paid for it. This is what's getting reported. Yep. As we get into these assumptions, again, fair to assume what's happening, and I know they get kind of confusing, but do the best you can. Requires that companies include in the accounting records only transaction data that can be expressed in terms of money. What you need to know about the monetary unit assumption is we're only reporting what I can put a value on in terms of money. I'm going to use an example of good versus bad. We'll use dentist. We all go to the dentist. Well, maybe some of you don't, but you should. Okay. I'm the world's worst dentist patient, so can you say, just because I'm a really good dentist, I'm really good, I can put a dollar amount on that? Not really. Okay. Or, ooh, they're the bad dentist. Don't go to them. We have to devalue their work just because they're known as the bad one. So there's things that determine money and not. And deciding if you're a good or a bad dentist doesn't make you worth less or worth more as far as the monetary unit assumption goes. If I can put a dollar amount, if I see X amount of patients a day and I'm a dentist, well, that can have a value. It doesn't determine if you're good or bad. That's how many patients I saw. So what you need to know about the monetary unit assumption is that it has a money tie to it, and there's no gray area there. The economic entity assumption, here was back to the gas example that Ira used, requires that activities of the entity must be kept separate and distinct from its owner. Kept separate is what you need to know there. Another Junk by Jenny example. I keep all of my inventory, and it spans about a 60-foot barn that's sitting out at my parents' house. That's where all my stuff is. Okay. We make a lot of trips to and from Morris out to my family farm. Well, it's also Grandpa and Grandma's house. So yesterday we were there. We dropped Ethan off so he could ride in the combine. Okay. I didn't grab any junk. It was not a junk day. It was drop Ethan off with Grandpa and Grandma. So should I record that as an expense yesterday of my mileage expense driving out to my parents? No. Well, later this week, we're going to go back out to Grandpa and Grandma's, but we're not going there for Grandpa Grandma reasons. We're going there so Junk by Jenny can get her inventory. Do you see the difference? Do you see if I was being unethical, I could count every trip to my parents' farm as a business expense? But I have to make that ethical decision because there's Big Brother watching me when it comes to reporting ethically. So I only record the trips to my parents when they're junk related. If it's for Grandpa, Grandma, or go to have Thanksgiving dinner, the gray area becomes, well, what about if on Thanksgiving dinner day that we drive out to my parents, I grab some junk while I'm there? Do you see how that gets a little bit gray? And I have to make the ethical dilemma decision of, do I report that or not? Most often I don't, just because of this. Because it's assumed that I am keeping business with pleasure, so to speak, separate. Finally, the last thing that I'm going to talk about, and then we'll get into some questions. The three basic forms of business, I thought it was kind of random that they slid it in here, but that's where they did. Okay. Okay. It did mess up your summary, yes. Our proprietorship, or what is called a sole proprietorship, a partnership, and a corporation. In this class, we're going to talk about corporations, but we're not going to learn about the accounting records. We're not going to do accounting stuff for corporations. We are going to spend the majority of our time here as if one person owned the business. We'll get into partnerships. I think it's actually chapter 12. I think it's chapter 12, and we'll talk about partnerships. What can you already tell about a partnership? It can be messy. Okay. Let's talk about proprietorships first. One person. They're typically owned by one person. They're often small with a service type business at its core, but don't be fooled by that service type. That means they're performing services. If I go open a hair salon, I'm performing services for, I'm cutting your hair. My vintage upcycling business, you could argue, is a service-based business because I'm providing a service of upcycling a piece for you, but it's more of a retail business in the fact that I sell my wares. The owner takes all of the glory, but the owner also takes all of the hits. The owner receives any profits, but also suffers any losses and is personally liable for all debts. So it's good when it's good. It's ugly when it's ugly. If the business is doing well, all of the money comes to that one person. If the business is financially struggling, who takes the hit? The owner. And if the business can't pay off the debts, guess who they come after next? The person. So if you have gone up and run around and rung up tons of debt everywhere and the business can't pay for those, the person better be ready to. So Junk by Jenny, if I'm running around as Junk by Jenny, just ching to ching to ching, and all of a sudden Junk by Jenny is now in the red, financially suffering, I can't pay my bills, guess who has to pay them? John and Jenny Mars, the people. So it's good, but it's got there's a lot of risk involved with sole proprietorships, especially in the first 3 to 5 years. Most businesses, if they're going to fail, will fail in that infant stage. Okay. Partnerships are owned by 2 or more. You can have a partnership with 5 partners, even though the word partnership makes it sound like 2. That's where you get more into the retail, but again, I don't even know if I like these. I don't like those. Businesses are service and retail. I don't know. I don't know if I like those. There's generally unlimited personal liability. Now we're going to get into the very, very detailed types of partnerships in chapter 12. And it's getting pretty complicated right here. I don't want to overwhelm you. I'll come back to that. But what you need to know about this, before these 2 or more people are going to actually form a partnership, they better sit down in a legal environment and draft what's called a partnership agreement, a contract, if you will. If Ira and I go into a business together, we better get a plan. Are we a 50-50 business? Is Ira going to take 70 and I'll take 30? What happens if I flee the country and now Ira's left by himself? There's a lot of what ifs that have to happen, and that needs to be in a contract-based nature. Okay, what if something happens to me physically where I can't be at work? Again, all of that is a contractual thing. But what you need to know, though, is there's limited and unlimited partners. Some partners could be in a bubble. Others can be almost like a sole proprietor. Again, I don't want to get into the details there, but there's limited and unlimited liability. How much of a safety bubble are they in or not? Okay. Finally, a corporation is where there is not one owner, rather it's all divided with shares of stock or stockholders, shareholders. It becomes its own legal entity. Like if you're going to sue Apple, the top dog isn't the one you're going to sue. You're going to sue the whole company because Apple is like its own legal entity at that point. Yes. On this side, because of the separate legal entity piece, you would be suing the business. Over here, you could, like if someone would sue Junk by Jenny, it's basically because of the unlimited liability, they'd basically be suing me. Yeah. There's lecture on 2 sections. Okay. How did it go? Pretty good? We have about 5 minutes. I want to just start doing questions with you. I want to start doing end of chapter work because then you don't have as much homework. A lot of your notes were really great. So you probably didn't end up writing a lot, but did you reread your notes as I was talking about them? Hopefully. I am going to connect to your computer so you can see. This is, Ira reminded me to hit record. If you don't have a connection to your computers, please do so because that makes it so much easier to see it right in front of you. Much better, isn't it? All right. I just realized I'm on the wrong slide here. Excuse me. Here is your list of what I want ready for the beginning of class tomorrow. I want you to do, so we've got end of chapter, and this is on my website. I had hoped to be able to do it during class. We're going to get started with it, and then you can do whatever else tonight at home. 2 things. I want you to do questions 1 through 10, and I want you to do exercise 1-1 and 1-2. Here's what's at the end of the chapter. We've got questions, we've got brief exercises, and problems. We'll always do questions, brief exercises, or exercises embedded in the lecture. We'll save those big beefy problems for at the end. Okay? So I'm going to help you. We're going to go right through the bell rings. Remember, if you're confused about anything that happened today, you can rewatch the lecture that I will have posted to my district website 6th hour today. So this is what I'd want you to show up with done tomorrow. I'll get you started. I'm on page 32 of the book. Typically, you won't see workbook pages for questions, so you would want to just add them to the back of your notes. So like the back of your chapter. So find the last page of notes that you took on this chapter, and then just put EOC at the top, end of chapter. That's why I have you do all of your notes, just so you can put your end of chapter stuff truly where it belongs. So find an empty spot in your notes. Let's just start with questions. I'm on page 32 in the textbook, question 1, down at the bottom. Accounting is ingrained in our society, and it's vital to our economic system. Do you agree? Notice they don't say do you disagree? Do you agree? And explain why. My apologies about it being slightly blurry. But the book says, yes, that is correct. We wrote a really long textbook for no reason, though. Virtually every organization and person in our society uses information. accounting information. So I'd say personally and in a business setting, accounting is used. I mean, even in your own lives, you have economic events that happen to you. You identify them, you record them, and you tell that money story somewhere. I know you've got to be on your way, but I want to just show you one thing. Here's what the exercises are going to kind of look like in nature. You might have that in your workbook pages. I'm not sure. I never know what's in the workbook. I just have my answer key. Okay. So in exercise 1, you're going to have all of these things that happen, and you're going to have to say, is it a communication side of things, recording, or identifying? Notice there's only one identifying. All of the rest are R or C. And then you also will have just identifying who are some internal users and who are some external users. Okay? And then we'll go through those answers right away tomorrow, and then we'll get into lectures, the third section already tomorrow with lecturing. So a little bit of homework. I'll update my website 6th hour, and you'd want to check it at some point during your day. So thank you. Have a great day.